Hey, Michael. Good morning. This is Kevin Hurley with Hurley Investments. Are you there, Michael?
I am. Good morning. How are you?
I'm doing good. Hey, we got through October. Let's talk a little bit about our market and what we have going on. For those that don't know, my name is Kevin Hurley. I'm that top guy on that right-hand side. Obviously, as you can tell, I'm not the best. I'm not the most photogenic individual. My bouncer is right below me. That's Michael down there. As you can tell, he takes the market very seriously. So let's just put this into perspective. This is what we do. This is our life. This is what we spend our days talking about. And we've got some good information for you today. Oh, man. You know what? I'm going to stop that. All righty. We are recording. Good morning, everyone. This is Kevin Hurley with Hurley Investments. Michael, I think you're there. Are you there?
I am. How are you doing this morning?
I'm doing good, although kind of interesting way to finish up our uh, our October for 2016. Just to let everyone know and see who we are. There we are. That's what we look like after a hard night of trick-or-treating. That's Kevin on the top. That's Mike on the bottom. But we're excited to talk to you because we want to go what's happening in our market today. In fact, we want to give you a basic recap of October and what we see going into the end of the year. This morning, very interesting as our market started to the high side, but we had some economic reports that came through. Sometimes you'll hear people talk about economic reports that, well, they're not really that important. They really don't matter. Michael, out of curiosity, what do you think the economic reports did today to our stock market?
The ISM came in a little better than expected, so I would have thought that the market would have recovered. So I guess construction spending took us down a touch.
Took us down a touch. I saw our markets roll over, being up 25 points to, wow, the sucker kind, in my opinion, rolled over and played dead. Well, maybe it's not dead, but it went from being up 25 to being down 25. And I sat there and thought, boy, I wonder how close we are to coming to some certain points that I call some lines in the sand. Some lines that if we break down below, we could look for a serious drop farther. We are testing that line on the S&P 500. In fact, Michael, if you want to talk about it or a comment about it, I'm just going to draw a couple drawings here where I'd like some people to take a look at what we're talking about.
The,
We
the
have,
longer-term trend line, the uptrend actually has already been broken to the downside, but the line you're drawing there on the SPX, I think I have pegged at 2119. So we are perilously close to breaking down below that and heading lower, which is surprising given the dollar's rolling over fairly heavily today, down a 0.5%. So it's a bit shocking to see.
it is, we obviously went through basically 2 months of sideways movement, and we broke through that level of support, hidden right in there with my great drawing, to now go through another 2 months of sideways movement. And to me, it almost looks like stairs. It looks like we're stepping down on the stairs. If we break through that 119, 117, 119, maybe 120 range, we're going to probably have another set of stairs that starts down here. And in my opinion, it'd probably keep in that 280, 285 range. Excuse me, 2080 or 2085 range is where I would expect to see us fall back down to. Any notions on what could cause that drop, Michael?
In my opinion, I believe the market is starting to price in, given the run of the dollar and the rising yields in treasuries, a probability of Fed raising rates in December. So the stronger dollar and whatnot would cause this whole cheap money phenomenon of everyone being ushered into the stock market to unravel. So it would seem to make sense. As a matter of fact, you showed that past chart of the last several months of stagnation. It's been a few years, actually, where we've pretty much gone nowhere after the Fed promised to start backing out of QE, and we're just in a holding pattern until something happens. So I'm actually, I wish they would start this tightening cycle. So that would be my guess as to your question.
Well, kind of interesting. We do have a Fed rate meeting tomorrow. Started today, will come through tomorrow for the rate decision. I'm pretty sure that there is going to be no rate hike in November. Main reason why, not that they couldn't, but the main reason why is that it is my belief, and as you take just a quick peek at it, so to speak, it is my belief that as you look at a rate hike in November, they do not offer any type of commentary afterwards. This is not a non-press release. So as you're getting this podcast today, you're getting the idea that they want to raise rates, they just can't, which will probably strengthen the resolve to raise rates in December. Where for my all intents and purposes, I think that's where people are expecting or counting on that rate hike in the first place. Any comments on that thought? Well, actually, you just thought they want a tightening cycle, and I would agree with you. I would also
Well,
say,
I think
go
they
ahead.
don't, but they kind of act like they have to because I think they've been talking about this rate rising cycle for so long. I think they're almost forced to, but I don't actually think they want to put a finer point on that. So
Yeah, well, it's kind of I can see your logic, and I'm excited to hear you talk about it a little bit later on. At the same time, I got to be honest with you, I think it comes down to some credibility that maybe, even though they don't want to be somewhat credible for the world, they have to be. I also will believe that a big portion of this sideways movement for 4 months was our election, was the fact that we have some candidates coming up here that, for all intents and purposes, I'm not sure anyone likes it. Obviously, the market has priced in a Clinton win. And I think that comes down to nothing more than if Clinton wins, they'll know what to expect from her. I found it rather interesting. I found the article, What Happens to the Markets if Donald Trump wins? Clinton still maintains the lead in the polls as emails resurface, and the FBI has found some other emails on on what do they call it? The candidates helpers server, that they now have some proof that maybe some emails were leaked out. I don't know if it's going to affect the election. I guess I don't want to say it doesn't matter, but it's interesting to see how that uncertainty has led to a stale or a stagnant market. Any comments on the election that you want to make, Michael?
no, no, thank you. I'm just enjoying the show. It's just it's going to be interesting to watch unfold.
No kidding. Very interesting. With that said, I just brought a couple pieces of information here, and I thought it was rather interesting. In that top left, and both found from the same place on CNBC, on that top left, best piece of market advice right now for millionaires is pretty simple. Invest. Yet 2 hours earlier, they had this same uh, advice that said millionaires investors move to the sidelines. So talk about contradicting each other. Same website, two pieces of literature going exactly the opposite way. As I look at which one I would trust more, do I trust Eric Rosenbaum or do I trust Robert Frank? Volumes tell me that millionaires or that investing in general has moved to the sidelines. Pretty low volumes. We're not seeing an uptick, or did we see the volatility in September that we were expecting? I'll be honest with you, a lot of people have taken their money or moving to the sidelines, which means we could have a potential end of the year run up or down, as people are obviously either playing catch up for those that did not move their money out to the sidelines, or for the money coming back in. I got that bottom left-hand corner. Strategist, when it comes to markets, the election isn't everything. That's true. Of course it's not. A lot has been said right now about oil being back below $50 a barrel. The fact that the dollar almost looked like it was going to break above the I guess it's the dollar index was almost breaking above the $100 mark. And the fact that we have a rate hike coming in December. No, the election's not everything. It's just the next hurdle the stock market has in front of us. Any news you'd like to go over, Michael, or do you want to jump into your slides?
No, but I think it's pretty appropriate what you're talking about as far as the uncertainty in the market, and there's always a differing opinion, and it's so confusing as to what you believe. So, which is what we are always talking. You made reference earlier, every single day, nights, weekends, just all the time about the market, and it's you have two of the smartest guys in the world you listen to on TV talking about the same stock, and they'll have completely opposing opinions. So how do you know what to do? Which is kind of the theme that I wanted to talk about here just for a second, if I could. So here's what happens, and this is kind of goes along with the election because overall, um, the political process is the main problem ultimately in the country, in so much as whoever promises, whichever candidate promises the most things to the most people generally wins the election. So they understand that there's not enough money to pay for that, and we run these huge deficits, and it's causing some structural issues the farther down this road we get. And so I just wanted to run through a couple things that I like to look at from a 30,000 foot global or a macro view to kind of clarify why we run our book of business the way we do, Kevin. So it all started, to me, as far as I can tell, in 2000. This is M2, this is the velocity of money, which is a measure of how many times a dollar is spent in the economy in any unit of time. So what you see, that 2000 mark where the velocity of money started to drop off, coincides with the blowing up of the dot-com era. And it changed people's behavior, I think, it looks to me like permanently. So what this shows is they're more apt to save their money uh, and not spend it in the economy. This chart is indicative of an economy that's not doing well as the velocity of money starts to slow. Now you can see that ramp up kind of in the early to mid 2000s, which was the housing boom. But ever since then, the velocity of money's dropping. So what that means is, from the government standpoint, whenever you stop spending, they jump in and spend more. So if you don't mind going to the next slide, sir. So this is the inverse of that. This is the total debt of the nation, which is 19.5 trillion right now. So you can see in 2000, we really started to ramp up spending. So as individuals spend less, the government spends more. And in my opinion, everyone hears about this debt, and it's going to be a problem, but people are just so tired of hearing about it. It doesn't really matter because nothing's really happened. So how can the government continue to spend more money, if you don't mind going to the next one, and the interest expense remains the same? So over the last decade or more, we've doubled the debt, but the interest expense remains the same. And that's why this debt is not an issue yet. But if you go to one more, Kevin, this is due to the government. This is what QE is all about, really. The central banks buy treasuries to lower the yield on the debt. So what happens ultimately is you stop spending, the government spends more, they raise the total debt, but the interest expense, what they have to pay on the credit card, if you will, doesn't rise because they have the ability to lower the rate on their credit card on their own. So what's going to happen is none of this is going to matter until it does. So obviously, I'm sure you hear all the time about negative real interest rates around the world, and the economies, many of the developed economies in the European Union are already negative. With this debt issue, they're probably a decade or so ahead of us. So the deal that's going to happen ultimately is they're going to continue to play this game, spend more money, drive the rates down so they don't have to, it's not an issue until we hit this thing called zero. So that's when it's going to matter because the government's going to continue to spend more money because that's the political process that the country's involved in. And as they spend more money, they'll continue to drive the rates down. The interest expense won't matter until we get to zero. Now, we are the world's reserve currency, and I think it's going to matter at some point. And that's when, people keep asking, when is, we run a hedged book of business. We don't just get long the market and hope for the best. We control the risk. And from the macro view, Kevin, I think that's why we do what we do, because these things will matter. But and I have been saying for some years now, don't ever the ability of the monetary and fiscal authorities to stretch this thing out for many more years, or a few years anyway, It's just what's going to have to happen. And ultimately, I think that's why the monetary authorities are not in any big hurry to raise rates because of this. Of course, there's the pension funds, the banks. I mean, they're all dying because they need to have that. They're all spread traders. They borrow short and they lend long, so they need a higher interest environment. But juxtaposed against this debt issue, it's a really difficult spot that they've gotten ourselves into. So, and interestingly enough, I spent some time over the weekend. Fiscal 2016 just ended, and the deficit was reported as $587 billion. But if you look at the total debt from last year was increased from 18.1 trillion to 19.5 trillion. So I'm not really sure how you square that up since your total debt has gone up as a country, total debt cumulative from it's increased 1.422 trillion, but the government says the deficit was only 587 billion. Well, the deficit or the total debt's just an accumulation of all the past deficits. So it's amazing. I mean, they just report whatever they want to. I'm sure there's some intergovernmental accounting going on with the total debt, but look, it's as simple as this in my mind, and this is why I trade gold and why I love the commodities complex in general. Because when you take the 1.4 trillion increase in money supply divided into last year's total debt of 18.1, that's a 7.8% increase in the money. Of course, they say there is no inflation, but inflation truly is a monetary phenomenon, so it has increased to the extent to which they've increased the money supply by the selling of treasuries. So that's we talk daily about these finer points and the ISM and the daily economic releases and this and that, but from a larger picture, this is what I'm always focused on because, but you know what, it doesn't matter, but it's going to matter. So anyway, I appreciate you giving me the time to run through that because to me, that's the whole ball of wax. So, and
You
it's
know,
going to
you're
come to
right.
the fore.
It is the whole ball of wax. And the way you just said it, it doesn't matter until it matters is exactly right. And unfortunately, as I look at it or I think about it, I guess the best way to make this comment is that we all know someone, a brother, a neighbor, a friend, a coworker that had some really nice stuff for a really long time, and you know they kept talking and bragging about how they just put on a credit card for 0 interest for a year, and then all of a sudden, when it matters, is when that introductory rate goes to something ballistic, like 18.86% or 24%, and there's no way they can pay it off, and unfortunately, our government has been very fiscally irresponsible. With that said, our October indexes, as you look down there, Dow is down 1%, S&P was down 2.1%, or NASDAQ was down 2.48%. October saw our biggest monthly losses since January of this year. It's just, the short answer is things don't look good. And as Michael talked about the fact on what we're doing and why, we're protecting right now. In fact, we've probably been protecting for a while here where it's been sideways this year or even for the last couple years because there's going to come a time when it matters. And again, if I could just impress this upon your heads, if our market loses 50%, you need a 100% return to get back to break even. You always need more to make up the losses. And the risk is to the downside. We always want to protect, even if it costs us a little extra money, so we can sleep at night, so we don't get caught off guard. And again, worst comes to worst, we want to be protected so that if our market's going to lose 50%, we want to lose 5 or 10. We don't want to have to make up that whole 50% back up to the upside because it's a 100% return on the money we have left. I appreciate you guys being here. I appreciate you listening to us to at least understand that we are taking our time to make sure that we understand what's happening in the market and why. Well, I also want to make the comment to you that don't worry about the stock market. What we do is in Hurley Investments is we watch the stock market so you don't have to. We're prepared to increase coverage of protection just for that purpose of seeing a fall in our stock market. We're here to protect you from that. We appreciate your business. Michael, anything else you want to say in closing?
No, I appreciate the time, and guess we'll see you next time.
We'll get this out to you. We'll see you again next week or the week after. You guys take care. Have a wonderful week. Bye-bye.
Bye bye.